Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. A lot of data from the US with respect to state of its economy. While employment-related numbers remain better than expectations, the overall manufacturer index lags behind expectations. Since currencies are relative, this needs to be in the context of other economies in the dollar basket. One trend we have been observing is the inflation falling more than expectations in some European countries. This influences the rate path for the ECB. I won't take much of your time. Let's dive into the updates. Good morning, JK. Take us through the host of data released yesterday and its implications.
Good morning, Swaraj. Yes, it was a really good risk-on day for the markets, helped by two major central bank members hinting at a pause in interest rates, and that is the best the market would have hoped for, and turned out to be a positive risk day. Equities up, yields down, and dollar down. Driving the sentiment has been a paring back of Fed rate expectations amid Fed commentary pointing to skipping in June, along with the mixed data flow. Pricing for a June hike now sits at 24%, while well below the 70% reached last Friday. And a full rate hike by July is now only 62% priced after having been more than fully priced. In fact, one of the reliable journalists report with the market values, the Wall Street Journal penciled a piece called Fed prepares to skip in June, but hike later, because this is one of the most closely followed headline that investors focus on. Now, the positive risk sentiment was boosted by recent data from US showing fall in unit labor cost, big fall in price pressures as per the ISM manufacturing report, apart from the main index itself continuing in contraction territory. The ADP report did beat expectations, but was offset by a big downward revision to the previous month. As far as the Challenger job cut report is concerned, US employers announced a layoff of 80,089 in May, which is a 20% increase from what happened in April. So far this year, companies have announced plans to cut 4,17,500 jobs, a 315% increase from what was announced in the same period last year. And it is the highest Jan-May since 2020. When due to pandemic, more than 1.4 million were recorded. Now, the inflation sentiment across European economies was an added impetus for risk sentiment, with the most now hesitant to even talk about the ECB rate hike beyond July, as their economy is also slowing. The Xiaxin PMI from China came in better than the previous indication from the NBS manufacturing PMI. That the Xiaxin came at 50.9. Actually, that boosted the sentiment in the Asian market. Wage pressure easing, employment situation weakening made a perfect setting for the Fed pause, or rather a skip. And with these early hints, at least one should not be expecting a very strong NFP tonight, but always we should be prepared for a surprise. What more do you want? European economy weakening. US has many data going a week. European inflation falling down, while in US the inflation is not falling as much as one would desire. Other indicators are definitely showing that a recession is not totally ruled out. Yesterday, one more Fed member, Mr. Harker, joined the previous chorus of calling for a rate skip in June. As for the dollar, it turned tail after earlier gains failed to challenge the previous session 2.5 months high, and weighed down by data hinting at moderation in price pressures as investors prepared for today's non-farm payroll report. And also, just as a coincidence, ECB's Lagarde, along with Harker, hinted at a potential pause in rate hikes in her speech last night. We got good retracement in euro, but the bigger mover was obviously yen, which is not surprising. Quite logically, commodity currencies gained with the risk improvement. The only currencies that lagged was Chinese yuan, which is still weighed down by poor economic data and low rates relative to others. However, in today's Asian trading, Chinese yuan has also regained some composure. And a favorable environment for risk also encouraged flows out of the dollar and a good rally in commodities. Brent gained 2.36% ahead of OPEC meeting. WTA by 3%. We also had copper rising by 2%, and gold itself was up by 0.75%. On the yields, US 10-year fell by 3.8 BPs to 3.60%. 2-year by 6.4 BPs to 4.34%. The world equity index, which tracks shares in almost 50 countries, added 1.1% to its index, and then US indices gained 0.5% to 1.5%, while the German index, which had recently faced a big selling pressure, regained by rallying more than 1%. Now, while the rest of the world is piggybacking on the US economy's weakness and the rates expectations, Indian economy is not only gaining from these factors, but also its own strength. Like following on the stronger than expected GDP and also the fiscal deficit, which is looking quite well in control, India's manufacturing PMI painted a notably positive picture for the sector yesterday, rising to 58.7 from 57.2. It has now remained above 50 mark, separating growth from contraction for 23 consecutive months. And over the past few quarters, the manufacturing sector has witnessed a solid growth, which has been one of the primary drivers of Indian economy. Now, while the regional peers such as China, Japan, and South Korea have seen their manufacturers struggle for prolonged periods, India has been standing, quite strong and tall in this regard. And we did have another, important development, that is the GST collections for the month of May, which recorded an increase of 12% over the same year-on-year basis. And the increase in GST collections has also come with the effective measures taken by the government for reining in the tax evaders, and with these measures, special measures for reining in the tax evaders will be in force for another 2 months, and it is expected that these GST collections will be in a robust measure for the coming months as well. And this augurs very well for our deficit to be well contained probably below the 6% mark, which the finance minister has indicated in our budget. Now, as far as the rupee is concerned, at last it has started to reflect some of these improvements in the fundamentals, although one would probably be skeptical about a one-way rally in the rupee because of the constant influence of the central bank, who always looks to contain its strength by absorbing the inflows, and also to see that rupee remains competitive among other currencies. Well, all in all, yesterday we did have a gap down open by more than 20 paisa, and through the day we did see selling pressure, and it has continued in the offshore market as well, based on the positive risk sentiment. Today, the main focus is on non-farm payroll report, and expectations are for a much lower number compared to last month, but we always are prepared for a surprise. But finally, at least till this weekend, we cannot but touch upon the debt ceiling. So the debt ceiling is now going for a vote in the Senate late tonight in the American time. So we will be knowing the final outcome of the debt ceiling talks, or rather it becoming a law in the US, and removing the uncertainties at least for the next 2 years. With that, wish you all a happy weekend. Thank you.
Thank you, JK. And overall, it seems it was a risk-on day. The driving sentiment was, of course, the Fed commentary of skipping the rate hike in June, while, of course, it is boosted by the cooling off in manufacturing-related data and an overall cool-off in price pressures facing the US economy. This risk-on sentiment was again added on by the European economies faring better when it comes to inflation. And domestically, Indian economy remains strong, stronger than expected GDP numbers. Manufacturing PMI painting a very positive picture. Indian manufacturing is standing out compared to its peers. While GST collections recorded a 12% Y-on-Y growth, we are seeing some strength in rupee, which is reflecting some of the strong fundamentals which India is having. That's it from us today. Have a very good weekend. See you all on Monday with another round of fresh updates. Thank you so much for listening.